Yes, Bharni, I'll change those.
So Nirja, we'll take a couple of minutes as all the participants join. So right now I see around 60 of them join, and then probably the number may keep going up.
So till then we'll flash our sponsor.
Yeah, that's right. Please do so. Nirja, maybe we can get started.
Yes, I think.
Good afternoon, everyone. Welcome to HYSEA NetSeries webinar, MSME benefits out of COVID-19 relief package, which is also called as Atmanirbhar Bharat Abhiyan. So subsequent to the annual of COVID-19 pandemic, Government of India has announced a relief package, which is 20 lakh crores for the industry, and of which there are certain announcements which are specific to MSMEs in the country. There are about 64 million MSMEs are there in the country, and then employing about 120 million employees. So even that number of 64 million is mind-boggling even for me. And one interesting fact is close to about 95% of those MSMEs are with an average employment of 1 or 2, it seems. So which means, so there are only 0.5% of the companies which are above certain level, and then 4.5% of the companies are above 10 people employment. Okay. So this webinar is primarily to understand, because there is a series of announcements done by the finance minister. MSME announcement, majority of them have come on a particular day, but I think there are also other announcements which might impact the prospects of MSMEs in the country. This is a webinar HYSEA has been thinking for quite some time, and we were waiting for the RBI guidelines to be coming to the banks, so that like we will be able to give some actionable guidance to the SME members of HYSEA. So today the day has come, and welcome all of you once again to this webinar. We have a great panel today. So we have a couple of gentlemen from KPMG and one from, so two from ICICI Bank out here. Okay. So this is a 1 hour webinar, and then so I'll go ahead and then introduce the panelists and give out the topics which they're going to actually dwell upon. We have Rajosik Banerjee, who's partner and head of KPMG Financial Risk Management. And so Rajosik is expected to talk about financial incentives covered under COVID-19 relief package, and also talk about some of them, what are the direct benefits and the notional benefits. And then if there is any fine print that which we need to understand for availing those, probably he would be talking about. Followed by Senthil, who's a general manager, who's joining us from Chennai of ICICI Bank, and he looks after the MSME sector specifically. So he's here, who could give us actually a practical insights in terms of how do MSMEs go about and then availing some of these loan products and any other collateral less options that are available for MSMEs, part of this scheme and then otherwise as well. We have Pradeep Narayan, Regulatory Services, part of KPMG. He's going to talk about a little bit about recategorization of MSMEs from the previous categorization to now, which is more turnover based, and any pros and cons with respect to that. And also direct and indirect tax incentives, deferments, and moratoriums that are available under the package, and then gives us some practical insights how MSMEs can go about and then use these. And we also have, so that's the three panelists who are there. And Rajosik, you want to go first? Talk about the financial incentives under the package and then the benefits and then how the companies can make use of it.
Kiran, thanks. I presume I'm audible. Just give me a thumbs up if I'm audible. Yeah. So can I have the presentation up, please, for the benefit of everybody? Can we get the presentation up?
Yeah, you just start. I'm just bringing it up.
Okay, sure. So I think while the presentation comes up, I think I just thought, we'll just have a precursor to, this whole conversation around, the whole incentive packages that has come out both from as a part of the fiscal policy as well as the monetary policy. Yeah, just remain with this slide. So just, let's just kind of maybe take a little bit of a step back. More often than not, in today's conversation, a lot of emphasis has been given around saying, okay, we have now got a pandemic and this is more like a financial crisis and, things are going bad. But, there's a very different situation of what happened in 2008 versus what is happening in 2020. I was working in London with a bank at those times. And the difference between what happened in financial crisis versus what is happening now is we not only have a financial crisis now, we've seen the markets, but we've also got a health crisis, we've seen survival issues, and it has also sort of been accentuated with a commodity crash that has come about. So therefore, if I really look at from a policymaker and central bank's point of view, I think the emphasis is therefore on two counts. One is around the household measures, what can be done on household, and second is around financial market. Now, let me just throw some numbers to you, and I'm sure most of you are aware. If I look at the, 2008 and when we had the global financial crisis, the overall GDP impact, so the world GDP impact was about 0.1 to 0.2%. Whereas when we look at the IMF outlook, post the pandemic, we are talking about a negative 3 to 4% of GDP growth. Now put in context, if that was what is happening in the world, what was happening with respect to India. So during the times of GFC, India was still growing.
Sorry for the interruption. One minute, Rajosik. I think Nirja, probably we might have to go to full screen.
Is it okay now?
Yeah,
perfect. Thanks a lot. Sorry, Rajosik. Please go ahead.
No worries. Thanks, Nirja. So if I just put in context with respect to India, India at that point in time was still having a GDP growth of 8%, and now as we speak, we are talking about EIU forecast, which has come about a couple of weeks back, and the EIU is talking about a 2.1. And if I go by Goldman Sachs forecast, which we are talking about 1.6. And the latest, when the governor was speaking, we were talking about a negative growth. So that is what is sort of on the anvils. So what are we therefore seeing globally on a policymaker's point of view, and then we come into India? What we are seeing on a global policymaker's point of view, both from the central bank as well as from the Ministry of Finance or Ministry of Corporate Affairs globally, we are seeing two set of measures. One set of measure is more around credit guarantee. We are seeing obviously a lot of liquidity infusion happening. We are also seeing some element of loan forbearances and incentives that is being passed on, tax breaks, and unemployment insurance in some shape and form. Obviously for us, unemployment benefit is not as much that is coming in, unlike what's happening in the Europe. Now, if I were to keep those two as a theme and then just talk about what's happening in India. So if we can go to the next slide. So we have got a conversation in two pieces. One is with respect, can we go to the next slide, please?
Yeah.
So the conversation is essentially broken into two parts. One is what we have seen as a monetary policy announcement. So there has been 3 monetary policy announcements in the month of March, April, and May. And we have also seen a fiscal policy announcement, as Kiran mentioned, is the Atmanirbhar Bharat. And how does that pan out from an MSME and SME as a segment, which will sort of be impacting you? Now, if I really look at what got announced on 27th of March to begin with, obviously there was a series of liquidity measures that got announced. There was a series of rate cut that got announced. So if I really look at from a rate cut, we had a 75 basis point cut in the repo rate. Reverse repo also got cut by 90 basis point, which therefore has lesser incentives of bank to park money with the central bank. We also saw some asset classification where, if you were investing when banks or FIs were investing in corporate bond, then they would get HTM classification. And then we had this whole thing around this 3,37,000 crores coming in the form of LTRO, in the form of CRR reliefs and the MSF reliefs. Now, while we see all of that, if I just talk about how that ended up transmitting in the first segment of the work, the transmission effectively happened that a significant chunk of that whole LTRO money, which is long-term repo rate that happened, ended up going to the larger AA plus rated entities. So if you were to look at it, the beneficiaries were the likes of Reliances and Tatas and Nabards, and this is all available in public. So there are two pieces that therefore come about. So is that transmission happening to value downwards? The answer is no. But there were two interesting trends that we saw. One, while the repo rate was at 4.4, if that is what the benchmark is to be considered, the pricing that we saw, and this is again in public domain, was anywhere between a 7.2 to a 7.5. And this is the pricing at which. So assume if you were to be a highly rated investment grade paper, that's what they're defined, then you are still talking about a 300 to 300 basis point of interest cost that one has to bear. Now that was obviously one concern. So is it all a factor of credit, or is it a factor of also liquidity, because refinancing was becoming expensive? The second challenge that came about of the whole LTRO was, is there a last mile transmission happening? Because what we saw is it's only the big names that were sort of taking the money. And thank you. I'm sorry, my kid was in the room. So what was happening, that the larger organizations were sort of taking the money, and the transmission was not there as much. But what we saw as another trend is all of the larger organizations who took benefit of the CD/CP market by accessing the LTRO was also doing some element of supply chain financing internally. So what effectively was happening was, if you are an auto company, if you were a manufacturing company, all of them were looking at the limits internally for their subcontractors and contractors. They were giving additional days of sales, which was giving some element of benefit. But was that being transmitted across the overall value chain? The answer was no. So that was one series. So obviously, the measure got announced, liquidity got infused, but the real benefit did not come in. The second piece that happened in the same monetary policy announcement was the whole series around moratorium. So there were two pieces. One, there was a deferment, and the second was a moratorium. So what happened was, there was something on the working capital where they said, okay, there's going to be a 3-month of moratorium that will happen. So effectively for the month of March, April, and May, you had an option, but that was not a blanket permission that was given. You had an option. So if you were an obligor, which is, if you're an MSME, SME, or a retail customer, you could go and approach the bank and seek a moratorium or a deferment. So for working capital, you would get a 3-month, and if it were a term facility, your whole EMI would get shifted by another 3 months. So while the intention was meant to be giving a relief, but what happened in reality was, one, people or organization who ended up making EMIs for the month of March, because this announcement came on 27th of March, effectively did not get as much of the benefit, because some organizations, especially across the NBFCs and MFIs, read it saying, okay, if I've received an amount, I will not refund the amount. Some of them refunded, some of them did not refund. So that was a sort of a mishmash that happened. Second, what happened is, what it effectively did, it pushed the whole storyline from March, April, May to make the payment in the month of June, especially on working capital, which was effectively saying that post 3 months, suddenly you have a situation of crisis. So, we were dealing with that. And third, what was happening is this was not being consistently being applied across banks and moratorium. So we actually saw a sort of a mixed bag happen, and therefore not a transmission started happening. If we move to the next slide. So then we had the next round. Next slide, please. Then we had the next round of monetary policy announcement from RBI on April 17, which was then to address specifically for MSME, SME. And what they effectively did was did two things. One is to ensure that since a significant part, and just to put numbers in context, in the current banking, NBFCs and thereabouts are doing almost about 40 to 50% of the credit, and banks are doing something similar. Obviously in the past we had seen a skew of more NBFCs in the last 2 years, but on the recent past it has gone down. So what they essentially wanted to do is give more liquidity to more stable NBFCs and the less stable NBFCs, so that the money can get transmitted through to as a last mile funding to the the MSME and the SMEs. What they also did is they got NABARD, SIDBI, and NHB to also start transmitting money. Now I'll put in context what's happening. So we have been working back with NABARD as a part of our engagement, because what has happened subsequently post April 17 is the Atma Nirbhar Bharat got the scheme got announced, which was the credit guarantee fund. So before the credit guarantee scheme or the partial PGCA scheme got announced, SIDBI started issuing two kind of loans. One is a subvented loan. So if you have not availed, you may want to consider that. So there is a subvention available where you would be getting at a subvented interest rate of about 5%, where there is a moratorium available, and you could make repayments after a certain period of time. So there was a subvented loan which was called the SAFE loan, which is how they're sort of marketing it. And there is another organization called SIDBI Ventures. So I'm sure you will have a lot of venture capital or fintech companies. So there's a SIDBI Ventures which had about a crore plus lending that they would be doing to ensure that this transmission happened. So clearly those were the agencies that started getting engaged more in market activities, and who started transmitting money across. What we've seen is there has been transmission happening, but the transmission has not been the best, and which is where I think we had the third round of announcement that happened. This was not the monetary policy announcement, but the fiscal policy announcement. So if you go to the next slide, please. So that's when we had the fiscal policy announcement that happened. So as a part of Atmanirbhar Bharat, there were two sequences that happened. One was this 3,70,000 crore got announced. So 3,70,000 essentially had two components. The first component was 3 lakh, which was collateral fee loan. So effectively, as an organization, so let's assume I am SMEA, so long my collective lending was up to 25 crores, I could get a 20% of top-up loan, which effectively meant a 5 crore loan. In addition, larger banks like, especially on the PSU banks, like SBI and all, they started creating an additional COVID line, which means that you could tap into additional facility. Now, the biggest advantage of doing this 3 lakh crore again was, this was in some way had an interest cap. Now, you will not call it subvented, but you would not go beyond a certain radar. Second, obviously the tenor of the repayment was up to a 4-year period, which effectively gave a bit of a breather that sort of came about. And more importantly, this was a collateral fee loan. So you would essentially look at accessing that market, tapping in that market. Now, if you recall, during the same time, a lot of conversation was happening around force majeure, where a lot of entities were facing the pressure around expenses. Can I do a deferment of expenses? But what happened, while this was a very heated conversation in the month of March and it trickled on to April, by the time we came into May, we realized that the legal enforceability of it is a bit of a suspect around it. So clearly that was not panning out. So what therefore is happening, and maybe as organizations, you may want to see that, are you tapping into this whole additional limit of 20% available, so long you are within that overall framework of 25 crores, and then get the benefit out of it. And then you had two other components. One is the stressed MSME, where the promoter has to bring in money. And that's where they sort of brought in this 4:1 leverage, where up to a 20%, which they call it as a PGCS scheme, partial credit guarantee scheme. So the government is going to absorb the first loss, which effectively means that first loss up to 20% of the loan value would be sort of taken by the government. Subsequently, it will be taken by the bank. And what we therefore saw, at least quite a few of the banks that we are working back with, is they have started looking at it slightly more closely. But this is only for stressed MSMEs and SMEs, where the promoter needs to bring in the equity share. And the third thing that we saw as a part of the overall story was this 50,000 crores fund of fund. And as we speak, again, just for the benefit of everybody, we are working back with the government to sort of define how this overall scheme is going to be done. So where they're going to be creating a mother-child relationship in funds. And then there's going to be a PEVC is going to be putting money. The government is going to be putting money, sort of in the ratio of 4:1 or a 5:1, because the credit guarantee is still about 20%, so it should be a 4:1 ratio. And there, this is something that you may want to sort of keep a close look at, because there is still an untapped 50,000 crore that is expected to come out shortly, and that is clearly available for taking up. The second piece that came about, and which may be again relevant for you, is the piece around the NBFC as a sector. So on NBFC as a sector, there were two announcements that happened. There was a 30,000 crore of additional liquidity that was brought in for a highly rated NBFCs. And there was a 45,000 crore of PGCS scheme given to NBFCs. Now, why is NBFC relevant for you? NBFC is relevant for you because this amount that the NBFC is going to be using through a PGCS scheme, which effectively means that there's going to be 20% loss cover given by the government, which effectively means that, if your historical loss was not as high, you could have that conversation with the banker and tap into more liquidity. To put numbers in context, what we have seen is, and this again has been monitored and administered by SIDBI. So SIDBI is the nodal agency which the government has appointed to do this disbursement. Eventual disbursement is going to be done by the respective banks, but the banks will have to effectively say that what facility, which MSME, SME is taking it, so that this is getting covered as an overall umbrella. So clearly you should start engaging with your bank to say that, okay, here is the scheme. What are we doing around it? How can I get an access to it? And by the way, let me give you some sense. About 80 to 85 banks, NBFCs, MFIs have already registered with SIDBI. So it cannot be that there's only a handful of 4-5 banks who are able to get access to this particular money. And there is already been enough that has been disbursed. So clearly there is headroom available, and there is credit guarantee available, which you should look at enforcing. So that would be my take. Clearly, credit is happening now. Two pieces one would need to focus on is around the PGCS scheme, which is both from an MSME and an NBFC point of view. Second would be around looking at the current funds which SIDBI is announcing, both from a SIDBI Ventures and a SIDBI Safe Fund point of view, and obviously talk back with your bankers to say that, okay, if there is an additional headroom that is available for 20%, how much of that could be made available to give you enhanced liquidity. The other thing that you will have to then look on is, just move to the next slide, is the third round of fiscal, the monetary policy measure that got announced. So we had an initial deferment of 3 months, both for the term as well as the working capital, so moratorium and deferment. They deferred it by additional 3 months. And what it effectively brought about is specifically on working capital facility, which I think most of you would be interested in. Now we've got the timeline of repayment, not in the month of September, because the moratorium gets over in the month of August, but up to 31st of March 2021. So you may want to time, because what it effectively says is you will now have fiscal year to pay it back. So you may want to time it basis your underlying cash flows that get generated, so that you're able to tie it back. Second consideration, and we realized that was sort of a bit of a sticky situation. If you have not availed, while everybody's talking about cash is king, take as much drawing, but if you have not availed the moratorium, please do your mathematics of the cost benefit associated to it, because more often than not, the impact of compounding on term is working out to be way more expensive than you would have envisaged. Now, obviously, if you're cash strapped, cash would be important, and therefore the moratorium benefit, even if you have not availed, you can still go back and avail with the bank, because that's typically, it will not be a retrospective availment, but a prospective availment. So I think clearly the lever around moratorium remains to be there. Please do your cost benefit analysis. Make your assessment with respect to the NBFCs. They are now flushed with more money. Make your assessment with SIDBI, because they have got specific MSME and SME schemes, and look at what the pricing is going to be there. Maybe I'll take a pause here, Kiran, and I'll hand it back to you.
Yeah, well, thanks, Rajeshri. A couple of quick questions actually before Senthil comes in for his part. Actually, these two subvented loan products, which are either from NABARD and then SIDBI, both are, is it collateral free, or is it there is a collateral involved here?
So that's a very interesting question that you're asking. So as of now, there is very little that you would have in terms of collateral fee. What is collateral fee is the 3 lakh crore which is available as a part of the Atmanirbhar, which is what you can tap into your existing scheme. I don't think there is much room around collateral fee. There are, by the way, some NBFCs which is outside these schemes who are offering some element of loan, because some of the organizations have gone bust on the collateral because the collateral coverages have gone up. But the pricing there are going significantly higher. But there are definitely schemes available, and some of the NBFCs are doing.
Yeah. So one more question here is, so is there any specific sector preference that these, while the outside of the collateral free 3.3 lakh crore of credit guarantee, the SIDBI and then NABARD, any specific sector? Because majority of the IT SMEs form part of the services sector, right? And good number of them, they wouldn't have anything which is that could be mortgaged or something like that. So it's basically 60% of our cost is our employee cost, and then working capital is very, very paramount for us. So is there any sectorial preference out there, or is it uniform across all sectors?
So maybe just to answer that, I'll take maybe a minute if that's okay with you. So what we're effectively seeing as a trend is, eventually everybody is going back to the, the U recovery, the V recovery, the W recovery. So what is therefore happening is, there are 4 sectoral outlays that has been sort of called out. Okay. So one is where they're saying there is going to be a hard reset on a sector. So hard reset is going to be more with respect to, say the brick and mortar, education, airlines, hotels, restaurant, and there obviously the time to get back is going to be very, very long, and hence they're saying it's going to be more an L-ish kind of a recovery, which is going to take long. If I come to tech as a sector, and I will break that into 2 parts. If somebody is into an online retail or their infrastructure thereof, if somebody is into more around streaming media, if somebody is more around interaction platforms, clearly there we are seeing a surge, and there the credit has perhaps been more than what it used to be in the past. So clearly we are seeing a surge in that sector. Remaining where, if it is going to be more around a tech ops kind of a role, we are seeing more of a U recovery there. So obviously it's happening. So I think you'll have to also do a bit of gradation. So the 4 quadrants that we're seeing is hard reset will be long. Surge is where we are seeing that the likes of Netflix or anything equivalent is going to be higher than modified. There's going to be transform to re-emerge, wherein your whole tech is going to be sort of coming in, which is going to be, in the U shape, which is going to be a midterm. And then you will have more around who is going to be focused more on, say, banking, insurance, consumer finance. Those would be the BAU, which is going to be coming in as a V. So we therefore anticipate that, you would be in the quadrants of a U, V, and surge, so to speak, and hence that gradation would happen. And the credit offtake is also happening in that particular manner.
Okay. That's great. Okay. Thanks, Rajosik. So, I think this was actually, I think we were only talking about Atmanirbhar, but I think before that itself, actually a couple of announcements and through which actually SMEs can derive certain benefits is a good point actually. That's additionally that which you have made. Thanks a lot. Senthil, over to you actually. So, whatever benefits that which Rajosik has told that how do one could avail practically, what is the step-by-step approach? The first priority, give it to the collateral free loans, what products which ICICI have or any banks would have, and then what should be the process? You can go on.
Yeah. So, good afternoon, everybody. I hope I'm audible. So I think I will be more on the micro side rather than on the macro side in terms of all these packages that have got discussed, to fundamentally say what is it that we do as a bank, what has happened because of COVID, impact of COVID, and what it has meant to the bank. And then we will go into the sector of fundamentally trying to look at this 3 lakh crore which has come in, a collateral free loan that we call it, and then say how does it get operationalized. I think that's the way we'll try to break this entire 10-minute time that we have. So fundamentally, if you go to the next slide, please. So what do we do from ICICI Bank more with regard to the software enterprises that are there is that we do a basic cash credit or OD, which is fundamentally working capital finance. And generally, we have found that the IT sector was not too much into this space, but of late, with the delay in payment realizations, we see some offtake in terms of cash credit and overdraft being availed. We have something called a FCNRB loan, which fundamentally is for working capital purposes, where you try to give it in the currency in which the receivables are received. So suppose you're having a dollar receivable, then we try to give a loan which is dollar denominated, and which has a benefit of being priced extremely competitive, and it helps in terms of meeting both your receivables and the loan being in the same denomination. So fundamentally, you get your receivables, you pay off the loan. Third is what is the classic packing credit facility that we have, which is against if you have a purchase order, and we try to give you a loan. It can be both in the domestic currency and in foreign currency. The fourth offering per se is what is in terms of very critical for people who are into the export side of the business, more in the export side of business, but also for the importers, is forward contracts, where you try and book your, you fundamentally hedge your receivables and ensure that the currency risk, you don't carry the currency risk. In addition, we obviously have facilities which are in the nature of a term loan, which could either be if any office or something that the IT company wants to buy, then we try to facilitate in terms of funding the requirement by providing a term loan, which again could be either in the form of a rupee or a dollar denominated loan. So these are broadly the offerings that we do as a bank to this sector. Now, if you go to the next slide. So what happened with COVID? I think there are multiple things which happened. Obviously, mobility got absolutely restricted. So people who were earlier being able to go to the branch or go to the bank have stopped going to the bank. The bank work timings itself have changed, and there are many branches which have been into the hot zone. So, we've had limitations in terms of being able to operate. Physical transactions have taken a beating. So, we used to have commercial branches where we used to have people sitting for getting their LCs or their BGs open. Those we have not been able to facilitate because people have not been able to congregate at a branch. So what has happened from the bank perspective is that a lot of these transactions, they are moved to the digital platform. So what has happened is, even if someone wants to open a ALC or someone wants to have a BG issued, all of those, I think we have been able to move to the digital platform. So sitting at his home, he makes the request online, and then we try to facilitate and deliver the document online. So I think that is something that has happened due to this issue of restricted mobility. And obviously, these are times where we have seen the currency moving at its peak. So whatever are the cash flows that we are receiving, I think somewhere we need to ensure that it's somewhere hedged and we don't take a hit on the currency side. So FX we have tried to move the platform to an online mode where you try and book your contracts online. And this time, the first time that we've seen that the IT sector is requiring working capital for its business purposes. So working capital has been enabled. And the other thing that we have done is we have tried to integrate, businesses, through the banking domain between the supplier and the vendor. So fundamentally, we have tried to link the whole chain to ensure that, sitting at your office or sitting at your home, you're able to carry forward the entire transaction without the requirement to go in and prepare any physical bill. I think that's digital transformation perspective. Go to the next slide, please. So this is, I think, something that I spoke of, fundamentally trade online. We have created a unique digital platform, and where exporters and importers are able to transact online without having the requirement to approach any of the branch. The entire requirement of IT companies or companies which are into the export side in terms of settling off their export bills digitally, I think that we have made extremely active. So we don't have any of those historical issues of bills not getting sorted out, bills not being squared off, leading to issues with the enforcement directorate and things like that. Those things we have tried to enable fully. And so today we hardly have issues of people having to settle their old P103 issues and issues which are related to advances having come in and exports not having been done, shipment delayed, and so on and so forth. What we have also put in place is what is called the Ibis Platform, which is entire transaction on the mobile phone. So we have about 130 odd features which have been added to the mobile. So business transactions, quite a lot of transactions that we would have otherwise been doing through either the corporate internet banking or through your laptop or your computers can now be done through the mobile. So that is something that we have enabled. And we also have brought in a couple of products, which is one is the Insta derivative product. Normally, if you look at derivative facilities, they're given along with working capital facilities. What we have done here is that we've gone in for a standalone derivative facility. So if you have a specific requirement where you don't want a working capital facility, but you want to hedge your currency, then we have something called the Insta derivative product. We also have created a product which is OD against your GST returns. So there we look at your GST return history and then try to give you OD limit, which is in terms of what Kiran said, where there is no requirement of a collateral or non-collateral loan, which is based on your transaction behavior. Go to the next slide, please. So this, in a sense, is what we call the stack that we operate on. So we have a few layers here. We have the accounts layer, where today, if you want to open a current account, you don't need to go to a branch. We have made it online, so you can have a current account.
So Senthil, for the interest of time, sorry for the interruption. One very key point that which we need to cover in time is that how do we avail that Atmanirbhar centric? So we can come back to this actually. So once we
not a problem. I think anyway, I think we have come. So just let's go to the next slide, and I think we'll go to the Atmanirbhar. And the next. This is InstaBiz. This is again online platform. So coming to the COVID package, so emergency credit line guarantee scheme. So who are eligible? I'm saying point one is who are eligible. Anybody who have a existing lending relationship with a bank or a financial institution, whether an NBFC or a bank, is someone who is eligible. The only criteria is that you should have had an outstanding on the 29th of February 2020. And two broad criteria that have been defined is one, that the top line of the entity should be below 100 crores for the financial year FY 2020. And second is that the loan aggregate from all the financial institutions together for the entity needs to be below 25 crores. So these are broad criteria that are required. And one important criteria that has been added by RBI is to fundamentally say that anybody who is 60 plus in terms of DPD will be excluded from the scheme. So as on 29 February, if you are running an overdue of more than 60 days, then you're not part of the scheme. What the bank does is basically check on satisfactory credit bureau reports. And there are a few criteria that the bank has laid down in terms of, credit conduct, operationalization of the business that they are into, and so on and so forth. And then we go ahead and pre-sanction these loans, and we communicate to the customer that 20% of his existing working capital limit can get given out as a loan. The loan will be priced as per the definition that the regulator has put in, not above 9.25%. What ICICI Bank has decided is to do these loans currently at about 8.25%. And these loans are term loans, which will be repayable over a 4-year time period with 1-year moratorium. So first year you have only the interest obligation, and the repayment is over the next 3 years. So 1 year plus 3 years, and 4 years the entire loan gets repaid. The other part is obviously for this loan, there's no incremental collateral that is required. There's no requirement of any processing fee. If there is a requirement that you want to prepay the loan in between, you have an option to prepay the loan. And obviously the concessional pricing I told is currently being pegged at about 8.25% for the bank. The other two parts of the credit scheme are, I think, what Rajosik spoke of. Fundamentally, one in terms of the moratorium 1 and moratorium 2. Initially, when the moratorium 1 was given, the expectancy was that the business will repay the interest. For term loans, obviously, it was getting pushed by 3 months. For working capital, at the end of the 3rd month, you are expected to pay off the interest, accumulated interest for 3 months. With the second deferment coming in, you have an option to further extend it by another 3 months and then repay the FITL which is created, which is a funded interest term loan that will get created, to be repaid by March. Important points to keep in mind is that if your cash flow permits, it is not prudent to go in for any of the moratoriums, fundamentally because there is a compounding of interest and you would actually be paying more than what you otherwise would pay. But if there is a cash flow issue, then obviously it makes sense to opt in for the moratorium. And with regard to the scheme which is there from perspective of incremental funding without collateral, I think the criteria are very, very simple. Your overall exposure below 25 crore to the banking system and the non-bank financial institution sector, have a top line which is below 100 crores and not in irregularity beyond 60 days as on the 29th of February. You meet these criteria, largely you are eligible, and then your bank is expected to provide the scheme. So generally all the banks are going ahead with what is called a pre-approved loan. So this is communicating to the customer that this was your outstanding as on the 29th of February and you're eligible for so much, and there are very simple documentations that have been devised which needs to be signed, and your account gets credited with the amount that comes with the guarantee.
So Senthil, one question here, important question here is basically, what if a company does not have any credit line with any bank? So far they have not taken anything from any bank. So can they not avail this loan at all?
They cannot avail this loan at all.
Okay.
This loan is only for existing. So what they can do, if there is a new requirement which has come in, I think there are enough and more institutions who are willing to look at them on a standalone basis and appraise them for credit without worrying about the emergency credit line. Emergency credit line is only for existing.
Okay. So there is one more question. If let's say as overdue with FI as on 29th of February to be less than 60 days past due. So is it any percentage of outstanding, or is it talking about only the overdue EMIs they're talking about, a percentage of the overall?
So there's no percentage. Fundamentally, it is how many days past due you are at. So if it is an installment, if it's a principal installment, it should not be more than 60 days. If it is interest obligation, it should not be more than 60 days, as on 29th of February.
Okay, got it. Yeah. Go ahead.
So I think that's about the package. I don't know how much time we have. I think we're already short up on time. So if there are any questions, we can obviously take it up.
Otherwise, we can take it up once after Pradeep comes in. Yeah. So I think we have a question hour for 10-12 minutes, and then we'll actually cover the rest of the questions. Yeah.
So that's all from me, Kiran. Then we go ahead.
Thanks a lot, Sandeep, and it's quite useful. So I think probably people might line up. Of course, you said that like if the people they need to already have a credit line, so banks will directly communicate with them. So that is definitely a music in ears for all of us. Over to you, Pradeep, and talk about some of these. I think Rajosik has touched upon some of these deferments, but probably you have any additional inputs with respect to the tax refunds and deferments. Please go ahead.
Sure. So thanks, Kiran, and good afternoon to everybody. So before we actually jump into the specific slides on tax, it's important for us to just understand the tax landscape that's prevailing today in India. So in light of it, in light of the fact that India had a very, very high tax rate, there was a significant thrust by the government to lower the corporate tax rates, and an ordinance was introduced last September, where corporate tax rates were brought down to 22%. With surcharges and education cess, this moved to about 25%. For new manufacturing companies, the effective rate of tax was 17 after including surcharges, education cess, etc. And at a 25% headline rate, and Nija, you can move to the next slide. At a 25% headline rate, India is one of the most competitive jurisdictions in terms of the headline or the effective tax rate, and maybe it's a lot more competitive than even several European jurisdictions. Historically, what's happened is the government's emphasis has been largely for the manufacturing sector, with the whole Make in India initiative, which the Modi government had right from 2014. And services sector, for some reason, had always it probably took the backstage. And that's also because India moved away from the whole concept of profit-linked incentives to something called as investment-linked incentives. So the only set of incentives which is available from a direct tax perspective or an income tax perspective for corporates operating in the IT, ITS or technology space is twofold. One is where they operate in SEZ units. And the second one is a benefit which has been conferred for eligible startups. So essentially, even for the SEZ units, there was a sunset clause, which meant that these units needed to commence operations before March 31, 2020 to be eligible for a tax holiday benefit. And the way the math works is they are eligible for a 15-year tax holiday benefit, staggered into 3 installments, a block of the first 5 years where the entire profits are exempt from taxes. In the second block, 50% of their profits are exempt from taxes. And the third block, 50% is exempt subject to making certain investments, etc. What the government has done is it's taken cognizance of the COVID situation and it's given a 3-month relief in terms of the commencement period. So if you commence even prior to 30th of June, very technically, you are entitled to claim the SEZ benefits from an income tax perspective. The second set of benefits which I spoke about is on the startup side of things. So what the income tax law prescribes is that you can claim a relief for a period of 3 years out of a block of 7 years. That was the provision earlier, and they have extended this block of 7 years to 10 years. And if you qualify to be an eligible startup, your entire profits are exempt from taxes. There was a turnover threshold of 25 crores earlier. They have extended that to 100 crores in the recent budget. So if you are an SME, with a turnover of sub 100 crores and you qualify to be an eligible startup, there are some definitions on what is a startup, etc. You can sort of look at availing this income tax benefit. So I would probably say that, from the audience perspective, these are 2 possible incentives you should closely look at in order to, reduce your direct tax or income tax outflow. What the government has also done is it has recognized that the intellectual mind with respect to startups, which is largely the promoter setup, etc., plays a very important role. And what they basically said was they deferred the taxability of ESOPs allotted to them. So in a very typical sense, ESOPs are taxable in the hands of employees or directors the year in which the shares are allotted. But if it's an eligible startup, you get a 4-year moratorium or a 4-year deferment in terms of the taxability kicking in. So that again is a very positive kind of a move to encourage a lot of intellectual investment kicking in with respect to startups. Can we move on, Neja, to the next slide? Yeah. So apart from that, a number of developments have taken place from a income tax perspective in the recent budget that was passed by the House of Parliament. So essentially, what has happened is the dividend distribution taxes has been sort of abolished, and India has reverted to a classical system of taxing dividends, which would essentially mean that dividends would be taxed in the hands of the shareholders and not in the company distributing the dividends. And again, this is beneficial for the company because to that extent, the cash flows are not sort of clogged or blocked. There is another important announcement with the introduction of something called as Equalization Levy. So when a non-resident sort of supplies goods or provides services online, and if he's characterized as an e-commerce operator, it attracts equalization levy at 2%. So as a consumer of these goods or services, one aspect that we need to bear in mind is if equalization levy gets attracted, the cost of these goods and services would become expensive to that extent. And therefore, you need to bear it in mind as you negotiate your contracts. There has been TDS which has been introduced on e-commerce services at a local level. So if you have Indian companies which are acting as e-commerce operators, their activities would be liable to a 1% TDS. And again, this will have cash flow issues from a recipient's perspective. And another important thing that's come up, from a government standpoint is that they have come up with an amnesty scheme. I won't say an amnesty, but a settlement scheme where they allow companies to sort of settle their past disputes without payment of interest and penalty. Earlier, the scheme was valid until 31st of March, and this has now been extended to December 31st. So as we move on to the next slide, some of the other COVID-related measures that has sort of kicked in from a tax perspective is on they basically extended the due dates. So wherever you had due dates of March 31st, that has been extended to June 30th, thereby giving enough relief for players to file their withholding tax returns, etc. The interest rates for delayed payment of taxes has been reduced. And that again is a significant relief from a cash flow perspective. Earlier, the interest rates were around 12 or 18% per annum. And this has been reduced to about 9 or 12% depending upon the kind of defaults, etc. So that again is a significant relief. Provident fund contribution, the government has come up with a mechanism whereby both employees and employers can contribute a lower quantum to a provident fund. Earlier, it was at 12%. This has been reduced to 10%. And this 10% is again optional. It is not mandatory. The only requirement is that both the employer and the employee will need to contribute a similar sum. What we also understand is from a provident fund perspective, the government is giving an advance against balances in your provident fund account or to the extent of 75%. This is a non-refundable advance, and it also doesn't bear any interest. So, if employees will need to avail that, we understand that there is a fair amount of speedy dispensation of cash on account of that. As we move on to the next slide, from an indirect tax perspective, a number of players in the software space, both on IT, ITES, are entitled to SEIS if their activities are within those prescribed parameters, and they are also non-STPI units. We understand that this has been extended till 31st of December, and typically the SEIS benefits is around 2 to 5% of your top line. So it's significant cash on the table. There are talks in terms of looking at a possible extension beyond December. So as in when that gets notified, it's something which players would need to be sort of cognizant of. We are also aware of the GST refunds being accelerated by the government, especially for the MSME sector. We understand that 90% of the refunds are getting expedited. That again is something which the government is extensively focusing on in terms of enhancing the liquidity and cash flow for the players in the MSME space. So in terms of takeaways, given this landscape, and Nidja, we can move to the last slide. In terms of takeaways, I would probably say that liquidity is one of the most important aspect which is a concern for players in the MSME space. So if you have multiple companies, the possibility of consolidating that is something which you should closely look at, because that will ensure liquidity and ensure higher cash flow in order to run your operations. What we are also increasingly seeing is that in order to ensure IBC protection, and generally MSMEs are vulnerable to that, loss-making businesses are slowly getting hived off, and that is something which should be at the back of your minds as well. Like I said, tax holiday claims or the startup deduction is something which a lot of MSMEs are looking at because they qualify for that particular threshold. But an interesting issue that has of late come up, at least for units operating in the SEZ, especially given that most of their employees are working from home, is whether they will have any challenges in terms of claim of tax holiday, because the business is very technically not carried out from the SEZ premises. We expect the government to be a little more liberal while granting this tax holiday benefits, etc. But that's another angle to look at. And lastly, even in terms of claim of deductibility of expenditure during the lockdown period, for the simple reason that you are not carrying on the business from that particular premises is another aspect that you will need to weave through as you look at your effective tax rate. So I would probably say these are the key considerations from a tax perspective. And largely the takeaways would be to expedite your refunds, see how you can ensure that greater liquidity is available from a tax perspective as you go about carrying on your operations. So that's all I had, Kiran. I mean, I'll pass on the baton to you. Happy to take any questions.
Thanks a lot, Pradeep. And we just finished 2 minutes before 4. With all your permission, I would like to extend a few more minutes the session, so to take up a few questions that which the audience have posed. I'll quickly start with it. The first question, so whether it is Senthil or Pradeep, whoever would like to take. So under this Atmanirbhar Abhiyan, is there any specific guidelines with respect to the structure of the MSME? Because several of the SMEs, the shareholding pattern is probably majority shareholding probably would have been there outside of India, or some are basically 50-50. So 50 is held by probably non-Indian national or a company outside of India. So is there a limitation or a guideline with respect to that?
So maybe Senthil, I'll go first and then you can just chip in from an operating perspective. See, I think my understanding of the Atmanirbhar, the package that was rolled out is that they have done away with services manufacturing distinction. So it's just an MSME that you need to look at. Micro enterprises are those enterprises with an investment of 1 crore and a turnover of up to 5 crores. Small enterprises are enterprises with an investment of 10 crores and turnover of, I think, 50 crores. And for medium enterprises, it's 20 and 100. So I think that's the definition which the government has come up with. And these are conditions that you will need to cumulatively satisfy. I don't think there's a distinction whether, the enterprises are domestically held, foreign held, etc. And I would tend to believe that, that's the way you will probably need to look at it. If you satisfy the investment and the turnover criteria, you qualify to be an MSME. But Senthil, if you have a difference
No, I think no, Pradeep, I second your view. Fundamentally, there is no distinction based on the holding structure of the company. I'm saying as long as the company meets the criteria on top line, outstanding, and credit conduct, I think they are good to go.
Yeah, excellent. So got it. So I think, guys, no need to bother about the structure. So I think as long as you're meeting the categorization criteria, I think you can go ahead and then apply for the law. There's one more question actually. So are private banks doing capital loans for working capital loans for MSMEs without a collateral? I think probably I would answer. So I think if it is as part of the Atmanirbhar, yes, but otherwise I think it is case to case basis, and then each of the banks would probably be able to.
No, I think there are a couple of products which are, the GST OD. I think there are some products which are there that the private banks also use. But fundamentally, it has to be driven by the comfort of the cash flow. So somewhere if people are able to see the cash flow, then we can do it without collateral. Or for example, a bill discounting facility. You have a bill, you are going to get your money after 90 days. You can get it discounted with the bank, and the bank will recover the money at the end of the 90 days. So there are some platforms which have been put on the digital mode also, where if both your principal and you are agreeable, then we all come into the common platform. You raise the bill on the platform, it goes to your principal, he accepts it's online, and I credit your account immediately. And at the end of the period, I recover from him. So there are those options which are available from a non-collateral based lending option.
Okay. So any entity, if it got registered in the month of June as an MSME, is eligible for these loans. I think up to October 31st or something like that. I think the date is there, right, for application of this.
Correct, but fundamentally you should have had an outstanding on February 29th. So I'm saying if you're a new entity, then you may not have had an outstanding on the 29th of February.
Yeah.
And if you have an outstanding on 29th February, the criteria is only 100 crore and 25 crore. You don't have to worry about the rest.
Okay. So right now, all schemes are talking of availing loans and then pay principal and interest at a future date. The prime question is, don't we have any business operations at all? Can this be addressed? Okay, so I think probably I'm not sure if any of you could answer. So one more question here is only nationalized banks. I think the answer is, I think every ICICI is a private sector bank. So I think all nationalized as well as private sector. What is a technical term, Senthil, that which you say?
So which one is this, Kiran?
I know somebody is asking that like these loans could be availed only from the nationalized banks or any banks primarily.
It can be available from any bank.
Any banks. That's all. I think the set of questions that which we have. If anything more that audience has, kindly send it to either me or to Nirja, and then we will get it answered from the panel and pass it on to you. But before you leave, there is a small feedback session towards improving our.
Kiran, I think there's one question. I think probably there's one question about 20% of outstanding calculated on fund-based or non-fund-based. To answer that question, it is fund-based alone. So you may have an overall outstanding of 28 crore, which is fund plus non-fund. What will get counted for 25 crore is only the fund-based facilities.
Okay, got it. Thank you. Guys, the rest of the questions will be taken offline. So can you spend a couple of minutes time and in terms of giving a feedback? There is only 3 questions there. the relevance of the content and coverage, the time allocated, and then the overall satisfaction. So please do ensure that you put your feedback and then before you log off. Thank you. Thanks a lot, the panelists, and thanks for taking time for HYSEA to work with you in future too. Thank you. Thanks a lot.
Thanks, Kiran.
you.
Thank you. Bye.